Thank you, Mr. Sakurai. Good afternoon, and welcome to Japan Society's special Luncheon program. My name is Hiroyuki Kasama, the President and CEO of Mizuho Bank USA, a corporate and trust banking arm of Mizuho Americas. It is my pleasure to preside at today's session. As you all know, the US economy has continued to expand over the past 10 years, and baseline outlook stay favorable. On the other hand, global economy slows down as is increasing uncertainty. Under such circumstances, the central banks have acted quickly and shifted towards increased accommodation globally. This helps offset negative impact on financial market and supports a sustained expansion of economic activities. Due to increased downside risk and muted inflation pressures, the target rate for federal fund rate was lowered for the first time in 10 years in July, and further in September and again this week. Now I'm delighted to introduce today's distinguished guest, Richard Clarida, Vice Chairman of Board of Governors of Federal Reserve System. Dr. Clarida has just finished 2 days FOMC meeting on Wednesday and will share with us his views and insights on the US, Japan, and global economy, which I assume factor into recent policy action. Vice Chair Clarida began his 4-year term on the board in September 2018. And prior to his appointment to the board, Dr. Clarida served as C. Harris Professor of Economics and International Affairs at Columbia University. In addition to his academic career, Dr. Clarida served as Assistant Secretary of U.S. Treasury for Economic Policy. In that position, he served as the Chief Economic Advisor to Treasury Secretaries Paul O'Neill and John Snow. From 2006 to 2018, he was a Global Strategic Advisor and later Managing Director with PIMCO. Dr. Clarida received a BS in Economics from University of Illinois and an MA and PhD in Economics from Harvard University. Please be reminded that the event is being recorded and can be seen on Japan Society's website. And also, unfortunately, Vice Chair Clarida is unable to take questions after his speech this afternoon. Now I would like to invite the Vice Chairman to the podium. Please welcome Dr. Richard Clarida.
Hiro, thank you for that warm introduction, and let me say it is just a delight to be here to the Japan Society. I visited the Japan Society way too long ago, early in my academic career. Jerry Curtis at Columbia, one of my colleagues and mentor, of course, is a good friend of the Japan Society. So it's been too long, and I'm very pleased I've had a chance to return again to the hospitality. And of course, this institution is a respected institution around the world dedicated to the study and the advocating and expanding interactions between the United States and Japan. While the Society's remit is broad and includes arts, culture, and education, I will, perhaps not surprisingly, focus my remarks on our two economies. Japan is an important economic partner of the U.S., and our economies are linked through trade in goods and services, as well as capital flows that affect interest rates and other aspects in financial markets. Through these channels, developments in Japan can affect economic conditions in the United States and vice versa. More broadly, beyond bilateral linkages, economic conditions in the U.S. and Japan are tightly linked to global economic developments. And today I will discuss several of the global factors that are relevant to the outlook for both economies. First, I will review the current U.S. outlook and some key global risks to that outlook that we are monitoring at the federal Reserve. I will next elaborate on the channels through which global factors affect domestic economic conditions in the U.S. and in some cases also in Japan. I will conclude with some remarks about the monetary policy decision that we announced on Wednesday. By many metrics, the U.S. economy is in a good place. The current economic expansion is now in its 11th year, and it is the longest expansion on record. The economy continues to advance at a moderate pace, with real GDP growth running at 2% over the past year and 1.9% in the most recent quarter. Growth has been supported by the continued strength of household consumption, underpinned in turn by a thriving labor market. And of course, we saw evidence of that this morning. The unemployment rate is near a 50-year low. Real wages are rising, and workers who had earlier left the labor force are returning to find jobs. There is no sign that cost-push pressures are putting excessive upward force on price inflation. And to me, plausible estimates of the natural rate of unemployment extend from just above 4% to the current level, at least. Core PCE inflation over the 12 months ending in September at 1.7% remains muted. And headline inflation, currently running at 1.3%, is likely this year to fall somewhat below our 2% objective. Price stability, as I see it, requires that inflation expectations, as well as actual inflation, be stable and consistent with our 2% inflation target. We do not directly observe inflation expectations, and I myself consult a wide range of survey and market estimates. Based on these estimates, I judge that measures of inflation expectations reside at the low end of a range I consider consistent with price stability. Although the baseline expectation for the U.S. economy is favorable, there are some evident downside risks to the outlook. Global growth has been sluggish since the middle of 2018. This slowdown in global growth, as well as increased uncertainty about the outlook for global trade policy, appear to be headwinds for manufacturing activity and investment spending in the U.S. and abroad. Also, another source of uncertainty in the global economy has been and continues to be Brexit. The global growth outlook also depends, importantly, on the strength and sustainability of continued economic expansion in China. China is balancing its desire to curtail credit growth and promote deleveraging against its understandable aspiration to maintain a rapid pace of economic growth in a country of 1.4 billion people. Finally, global disinflationary forces remain and present ongoing challenges to many central banks in their efforts to achieve and maintain price stability. In sum, global conditions present headwinds for the U.S. outlook, and as my colleagues and I at the Federal Reserve has emphasized, these headwinds have been a prominent consideration in our recent monetary policy assessments. I would now like to elaborate on some of the channels through which foreign developments more generally might be expected to impact the outlook for the U.S. economy. Perhaps the most direct link between economic conditions abroad and in the U.S. is the foreign demand for U.S. exports. Now, to be sure, exports account for a smaller share of the U.S. economy, about 12%, than the global average of about 30%. Even so, when foreign demand for U.S. exports falls, the effect on U.S. production is evident. The pace of economic expansion abroad is a key determinant of the demand for U.S. exports. Most recently, the IMF projects foreign GDP growth in 2019 to have slowed to its weakest pace since the financial crisis. Largely as a result, U.S. exports have been about flat over the past year, an unusual development outside of recession. U.S. exports have also slowed as a result of a decline in exports to China, following the imposition of tariffs on U.S. goods, and also more recently because of production-related disruptions in aircraft deliveries. The pace of economic growth in our major trading partners affects the demand for U.S. exports not only directly, but also indirectly by influencing the value of the dollar. When foreign growth weakens and central banks abroad ease monetary policy to support their domestic economies, returns on dollar assets appear more attractive, capital flows into U.S. markets, and these flows will tend to boost the foreign exchange value of the dollar. In addition, elevated uncertainties about the global outlook and/or other evidence of financial stress abroad can also drive up the value of the dollar, as investors flow into the safe haven traditionally provided by U.S. assets. A stronger dollar for either reason makes U.S. exports more expensive for foreign buyers and makes U.S. imports from abroad more attractive to U.S. purchasers, and these effects thereby tend to lower the demand for U.S. goods and services. Now, that being said, I would note that the value of the dollar does not appear to play much of a role in explaining the decline and sharp slowdown in U.S. exports over the past year. The current level of the trade-weighted dollar is about where it has been on average for the past few years. However, looking back several years, the 25% appreciation of the dollar that occurred in 2014 was an important contributing factor to the previous noticeable decline in U.S. exports that took place in 2015 and 2016. Global financial markets also link the U.S. to the global economy, and developments abroad can spill over into domestic financial conditions, with material effects on domestic activity. This is particularly evident during episodes of global financial stress, in which risk-off shifts in sentiment can depress U.S. equity prices and widen domestic credit spreads, even as flight to safety flows push down U.S. Treasury yields. These global financial spillovers to the U.S. economy were notably pronounced during the 1998 Russia crisis, the euro area debt crisis earlier this decade, and the China devaluation episode in 2015 and 2016. Recently, global financial spillovers have contributed to the significant decline in U.S. Treasury yields that we have seen since the spring. Since the market for debt is global, low and in many cases negative yields abroad encourage capital inflows that put downward pressure on U.S. yields. Equity prices have also reacted to global developments and recently appear particularly sensitive to news about the outlook for U.S. international trade. Global factors have likely also contributed to the estimated decline in the neutral rate of interest, or R*, that we've observed in the U.S. and in many other countries. Slow productivity growth and population aging have lowered potential growth rates in major foreign economies, decreasing demand for investment and increasing desired saving, both of which have contributed to lower equilibrium interest rates abroad, with spillovers to the rest of the world, including the United States. Global developments influence not only U.S. economic activity and markets, but also U.S. inflation. Global factors, through their influences on U.S. aggregate demand and supply, can alter U.S. inflation dynamics. Foreign factors can also directly affect the prices paid by U.S. firms and consumers, particularly, but not exclusively, for imported goods. An appreciation of the dollar can lower the dollar price of U.S. imports, although empirically this effect is less than 1-for-1, as foreign exporters tend to keep the dollar prices of their goods comparatively stable relative to observed exchange rate fluctuations. In addition, swings in global commodity prices influence U.S. inflation. Over the past year, the rise of the dollar and falling oil prices have been important contributors to the subdued pace of U.S. inflation. Let me turn now to Japan in the global economy. Up until now, I have focused on the U.S. economy. However, despite some important differences that I will note, the Japanese economy exhibits some notable similarities to the U.S., both in terms of its overall performance and its exposure to the global economy. To begin with, Japanese growth, while slower than in the U.S., has been running above the pace needed to absorb new entrants to the labor force, and its strong labor market is operating with an unemployment rate near multi-decade lows at 2.2%. Also, as in the United States, weak exports have recently been a drag on Japanese growth. But like the U.S., Japan has been less exposed to the global slowdown than many other countries. Exports represent only 17% of Japanese GDP, higher than in the U.S., but well below the 30% global average that I mentioned earlier. In some respects, however, Japan is even more strongly linked to the global economy than is the U.S. One example is the relationship between episodes of global financial stress and the exchange rate. In times of stress, the dollar tends to appreciate as investors seek the safety of U.S. markets. But the same is even more true in Japan, with the yen often recording even stronger appreciation than the dollar in times of increased risk aversion. Some other channels operate differently because of structural differences between the U.S. and Japan. One difference is the currency used to invoice trade. In the U.S., almost all trade, both imports and exports, is invoiced in dollars. One aspect of this, as mentioned earlier, is that changes in the value of the dollar tend to have a relatively limited effect on U.S. import prices and import demand. Despite the importance of the yen in global financial markets, a significant portion of Japan's trade is also invoiced in dollars rather than yen, including not only Japan's exports to the U.S., but also its exports to other countries in Asia. Some scholars have proposed that the importance of the importance of the dollar in Japan's trade lessens the responsiveness of Japan's exports to movements in the yen, while making exports more sensitive to changes in the value of the dollar and therefore U.S. monetary conditions. Regarding inflation, through the considerable efforts of the Bank of Japan's quantitative and qualitative monetary easing program launched in 2013, Japan has emerged from almost 15 years of modest deflation and is now operating with a positive inflation rate. While the inflation rate remains below the Bank of Japan's long-run objective of 2%, it does represent a notable accomplishment given the difficulty of changing public inflation expectations after a long period of modest deflation in consumer prices. Let me conclude with some comments on our recent policy action. At our meeting earlier this week, the Federal Open Market Committee lowered the target range for the federal funds rate by 1/4 percentage point, bringing the range to 1.5 to 1.75%, the third such reduction this year. As Chair Powell noted in his press conference, the committee took these actions to help keep the U.S. economy strong in the face of global developments and to provide some insurance against ongoing risk. The policy adjustments we have made since last year are providing and will continue to provide meaningful support to the economy. The economy is in a good place and monetary policy is in a good place. The policy adjustments we have made to date will continue to provide significant support for the economy. Since monetary policy operates with a lag, the full effects of these adjustments on economic growth, the job market, and inflation will be realized over time. We see the current stance of monetary policy as likely to remain appropriate as long as incoming information about the economy remains broadly consistent with our outlook of moderate economic growth, a strong labor market, and inflation near our symmetric 2% objective. Of course, if developments emerge that cause a material reassessment of our outlook, we would respond accordingly. Monetary policy is not on a preset course, and we will be monitoring the effects of our policy actions along with other information bearing on the outlook as we assess at each future meeting the appropriate path of the target range for the federal funds rate. Thank you very much for your time and attention and for the invitation to speak at the Japan Society this afternoon. Thank you very much.